Facing the upcoming financial crisis, insights and strategies. Over the past few decades, we have often been taken aback by seemingly unpredictable economic events. However, a closer look at history reveals that many of these events follow recurring patterns. By understanding these economic cycles and historical trends, we can better prepare for potential financial crises in the future. Economic cycles and recurring patterns. Economic shocks frequently occur because we have not experienced them in our lifetimes. However, by studying historical events, we can see that these patterns have occurred repeatedly. Major financial crises, such as the Great Depression and the 2008 financial crisis, share similarities in their causes and impacts. The Great Depression, which began in 1929, was characterized by a massive stock market crash, widespread bank failures, and prolonged unemployment. The 2008 financial crisis was triggered by the collapse of the housing bubble, leading to a global recession and severe financial instability. Both crises resulted from excessive risk-taking, inadequate regulatory oversight, and unsustainable debt levels. These recurring themes highlight the importance of historical analysis in predicting and mitigating future financial crises. 3 major threats. Currently, there are 3 major threats that we have not experienced in our lifetimes but have significant potential impacts: debt levels and money creation. The current levels of debt and the rate of money creation by central banks are unprecedented since the 1930 to 1945 period. Governments and central banks worldwide have accumulated massive amounts of debt to stimulate their economies during crises. While this strategy can provide short-term economic relief, it burdens the economy in the long term, as this debt must eventually be repaid. The significant increase in money supply can lead to inflation, eroding the purchasing power of currencies. Central banks, like the Federal Reserve, have been engaged in extensive quantitative easing, injecting trillions of dollars into the economy. This unprecedented level of money creation has raised concerns about long-term financial stability and the potential for future economic downturns. Internal conflict. Increasing levels of populism, irreconcilable political differences, and growing wealth gaps pose a significant threat to social and political stability. These disparities are greater than those seen in the early 20th century and could undermine the foundations of democratic governance. Populism on both the left and right has intensified, leading to polarization and gridlock in governments worldwide. The growing divide between the wealthy and the poor has exacerbated social tensions, creating fertile ground for political instability and economic uncertainty. This internal conflict can disrupt policymaking processes, hinder economic growth, and amplify the impacts of financial crises. International conflict. Intensifying global competition, with major powers vying for economic and military dominance, is another significant threat. This shift in global power dynamics is reminiscent of the geopolitical tensions seen during the 1930 to 1945 period. The rivalry between the United States and China exemplifies this international conflict. As China continues to rise as an economic powerhouse, it challenges the established global order dominated by the United States. This competition can lead to trade wars, technological rivalries, and military confrontations, all of which can have profound implications for global economic stability. Learning from history. To understand these threats, we need to study history, examining the rise and fall of currencies and empires over the past 500 years. This historical analysis provides insights into how economic cycles, internal conflicts, and international conflicts interact and affect global stability. For example, the rise and fall of the British Empire offer valuable lessons. At its height, the British Empire controlled vast territories and dominated global trade. However, the costs of maintaining its empire, combined with internal social unrest and external military conflicts, led to its decline. Similarly, the Dutch Empire's rise and fall illustrate the impacts of financial innovation, military overreach, and economic competition. Monetary policy and its impact. Central banks are currently trying to reverse the excessive money creation by raising interest rates. This move could cause real economic pain, including a likely increase in unemployment. However, such measures are necessary to control inflation in the long term. The Federal Reserve, for instance, has signaled its intention to increase interest rates to curb inflationary pressures. While this policy can help stabilize prices, it also poses risks to economic growth. Higher interest rates can lead to reduced consumer spending and business investment, potentially triggering a recession. Balancing these competing objectives is a critical challenge for policymakers. Reserve currencies and the value of the dollar. Despite the apparent strength of the US dollar compared to other currencies, all major currencies are depreciating in terms of purchasing power. It is essential to find a safe store of wealth in this environment. Historically, reserve currencies like the British pound and the US dollar have been considered safe havens during economic turmoil. However, as these currencies face challenges from inflation and declining purchasing power, investors must seek alternative stores of value. Gold, real estate, and other tangible assets can provide a hedge against currency depreciation and economic uncertainty. Safe stores of wealth. In the face of inflation and global uncertainty, it is crucial to invest in inflation-hedged assets such as gold, real estate, and education. Diversifying investments is also essential to reduce risk. Gold has historically been a reliable store of value during periods of economic instability. Its scarcity and intrinsic value make it an attractive hedge against inflation and currency depreciation. Real estate. Investing in real estate can provide both income and capital appreciation. Properties in stable markets can offer protection against inflation and generate rental income, making them a valuable addition to an investment portfolio. Education. Investing in education and skills development can yield long-term benefits. Enhanced skills and knowledge can increase earning potential and provide a buffer against economic downturns. Diversification is key to managing risk. By spreading investments across different asset classes and geographic regions, investors can reduce their exposure to any single economic shock. This approach enhances the resilience of an investment portfolio and improves its long-term performance. History offers valuable lessons about the future. By understanding economic cycles, internal conflicts, and international conflicts, we can better prepare for upcoming crises. Although current measures may cause short-term pain, they are necessary to create long-term stability. In facing an uncertain future, we must remain vigilant, learn from history, and make wise decisions in managing our wealth and investments. With the right strategies, we can mitigate risks and capitalize on opportunities. By adopting a long-term perspective, diversifying investments, and prioritizing essential assets, we can navigate the complexities of the modern financial landscape. While challenges are inevitable, a well-informed and strategic approach can help us achieve financial security and stability.